Hello, everyone. Recently, some new research just came out in the world of personal finance. That's specifically coming from James Choi, a high regarded professor of finance coming from Yale University. He recently just came out with something that kind of shifts the landscape in formula investing. It's actually built upon a research paper he put out over a year ago about life cycle investment choice. And today I'm going to be discussing a little bit of the formula itself and why this is actually relatively important to take note of, and then also kind of demonstrate because the team was, well, nice enough to put out a Google Sheet that you can actually utilize and kind of see this formula in action before ending off with some of my last minute thoughts on the formula and what it means to formula investing in general. So, without further ado, let's get started. Right away, when I say formula investing, if you're a like minded individual to myself, you probably have a slightly negative thought when it comes to formula investing. This is because formula investing tends to oversubscribe fixed income positions in portfolio. It tends to err on the conservative sides and overall just leaves a lot to be desired. Granted, formula investing isn't necessarily perfect by any means, and I think one of the reasons that is because it tries to do an impossible task, and that is come up with a one size fits all solution to, well, every individual person's investment options, right? That's not a thing that can necessarily be done. So I respect any formula edition that is actually of quality and tries to not err too much on the conservative side. And that's why I really wanted to discuss this recent formula they're dubbing the Choi formula that just came out. That's because a lot of users have found that utilizing this formula, and specifically the spreadsheet that the team put out, actually tends to err on the side of owning significantly more equity than not only the other formulas, but maybe people would consider in general. Now, some of the previous formulas that this looked to not only build upon, but really kind of make outdated was, of course, you have your horrible 100 minus your age to get your equity percentage to fixed income percentage. That's personally my least favorite. You also have the classics, such as the 60/40 portfolio construction. And then, what a lot of you are probably familiar with inside of your retirement accounts, you have the formulas utilized by target date funds, which can kind of vary depending on the company that's actually running that fund. But overall, the idea behind the target date being that the closer you get to retirement, the more conservative your portfolio becomes. So, again, this is a formula that's meant to kind of not only build upon those, but really just destroy them completely and give a real, true, viable option to formula investing. So, right away, one of the really interesting components of this formula that helps it stand out in a sea of just, well, icky formulas is that it tries to take into account your future financial situation. And one of the interesting ways they do this is they view all of your years of future income and retirement benefits kind of as a fixed income position in and of itself. That's because these aren't likely to necessarily be volatile in alignment with the stock market. These are some things that will tend to grow typically if you're staying in the same field or if you're trying to progress and get higher pay. The more experience you get, like I assume most individuals would do. So they try and treat that as a conservative portion of your portfolio already. Just taking into account that puts them in leagues ahead of all the other target date funds that don't necessarily look into your future earning potential, how much income you're going to end up retiring with, or guesstimates around that, and then retirement benefits. They just try and fit one size fits all in an easy formula. Another really interesting thing to note inside of the Choi formula is that it actually treats individuals with more investable assets differently. So, for instance, if you had a married couple in their mid 40s and you took another married couple, identical ages, identical salaries, all of that, right? But let's say your first couple has $400,000 in investable assets. And then your second couple just simply will double it, $800,000 in investable assets. The Choi formula will actually treat the 800,000 right? It'll give a more conservative estimate as to your equities to fixed income. So it'll give you a much greater fixed income percentage of that portfolio. And the thing I found really interesting with this was the logic they gave with this decision is that the 800,000 represents a much larger piece of the total pie of both families' future like composite incomes, right? All of the income they'll ever generate through their wages and retirement benefits, that $800,000 makes up a much bigger portion, and therefore they should be more conservative. Now, if you're starting to think ahead, you might necessarily not like that, and I'll kind of touch on some ideas towards the end as to why I don't necessarily view that as the best, but for their goal, it makes sense. Now, let's talk about the third piece of the pie, so to say. What the third component is that makes the Choi formula different from all the other formulas. And that is it tries to take into account risk tolerance and specifically risk avoidance. So, as I'll demonstrate in the actual spreadsheet itself, you can actually put a score for your risk aversion 1 through 10, 1 being someone we might consider as a risk seeking individual, and 10 is someone who think of it as they bury all their cash in the backyard, right? They can't stand the idea of any volatility in their portfolio or anything. If they see it go down, they freak out. And this is something that again differs from all the other existing formulas is that they don't try and necessarily take into account each person's risk tolerance. And that's a big leg up on the competition when we talk about utilizing the Choi formula. Now, without further ado, I'd like to change it over and we're going to be walking through the spreadsheet. I'll show you guys some examples I came up. So overall, I'll walk through that and I'll give you guys some final thoughts as to what I think about the Choi formula and formula investing as a whole. So, as you can tell, I've moved over the spreadsheet to an Excel file. We open up on their little disclaimer page about not utilizing this for anything outside of educational and research purposes, which again, I probably wouldn't act specifically on your inputs into the formula as I'll talk about, but I'll now walk you guys through some sample situations I create just to demonstrate. All right, so what you're looking at here is just an example situation I created. I had two adults. I made it very, very simple and said they make $100,000 a year starting out, and optimistically, they get 3% raises each year in line with CPI, or at least the goal for CPI, right? Overly optimistic, but whatever. It's not going to be a 100% perfect representation. So, as we see right here, what we're looking at, I put in their investable assets. Let's say right now they're just coming out of college, they scrape together their money, and they have $20,000. And then we put expected stock market real return. This is kind of interesting and something that I think gets a little bit wonky is it allows you to actually input your own thoughts for the stock market real return in risk-free interest rates, right? I just threw in inflation, right? And for stock market, I just threw in a guesstimate of 10%. So I think these are going to be things that kind of make the Choi formula not the best to act on, is it does require you to, for instance, I'm in the full inputs version. So I actually inputted all of my future wages and retirement benefits, right? These are going to be things that I feel a lot of individuals will probably disproportionately view as super optimistic. I said it myself, 3% raises into perpetuity in line with CPI. Yeah, that's probably not happening. But we can pretend and we can be optimistic. So right away, as we see, the recommendation from this situation is something I actually really like to see. It has an equity portfolio share of 100%. Now, as I mentioned, this formula builds upon life cycle investing. And life cycle investing is actually a really interesting concept. Basically, and I think why people are finding this formula tends to not oversubscribe on equities because I feel like it should be at this, but for most other formulas, it definitely oversubscribes equities. The reason it does that is because life cycle investing preaches that at a young age, you can withstand pretty much anything in the stock market. Why? Because you have a time horizon of 40 plus years. Some of the like really far ends of the life cycle investing strategy actually have you taking on margin immediately, right? Because if you have 150% drawdown and it eliminates your wealth early on, you'll actually come back and come back stronger, still utilizing that approach. That's just kind of the life cycle investing idea. So it prescribes 100% portfolio share into equity, right? That's going to be in this box right here. Now, this is obviously going to be a lot higher than the dreaded 100% minus your age. I actually feel much more in line with this. This would be something that if I were in this situation, I would definitely be shooting for a 100% equity portfolio share outside of maybe some extreme instances, because I do like to be slightly more active than some in academia might say you should be, as in taking advantage of opportunistic situations. But overall, right now, I view this as something that definitely wouldn't be recommended to all individuals, but in this formula, it's nice to see that it really pushes you to try and invest more into equities. Now, I'm going to flip us over to a different situation that I think kind of outlines a bit more drastic of an approach to what the other formulas would actually indicate. So, what you're seeing right here is a very, very simple, practical situation that I think will demonstrate my points on the Choi formula more than just simply going to youngest possible, right? We have two retired folks, and let's say their retirement benefits, I made it dead even. They each make $35,000 a year. It doesn't grow in retirement benefits. Again, we're just going for simplicity to demonstrate. And I put investable assets at $1 million. So they're retired, and obviously they don't want to have any wages because they're retired. And imagine trying to enter back into the workforce at, say, 85 or something. Additionally, if you look at this top input right here, I made our risk aversion a 9 out of 10, right? Maybe they don't necessarily want to bury all their money in the backyard, but they would put some of it into treasuries. Again, we have our expected stock market return of 10% and risk-free rate. I just threw that as the CPI estimate. It realistically would probably be slightly higher than this, but oh well. So, what this actually demonstrates that a lot of formulas would vary very, very, very far away from is it actually recommends a 47% equity portfolio share. Typically, when we look at formulas, I mean, doing the 100 minus your age, right? 29 or whatever. Or, sorry, I was looking at the 71. It would be 30, right? But what we're seeing is this is actually giving a significant push in the equities. And I can't even imagine target date funds when you've already retired, right? They might still exist technically if they aren't like fully closed, but it's going to be almost all in fixed income. So what we're seeing here, right, is a significant push to hold on to more equities. And I think that is what they were really going for, because when you look through the paper, there is a love for equities, and it makes complete and total sense if you've kept up with equities versus fixed income. Fixed income hasn't been great since inflation was sky high. That's just the truth, right? It hasn't been wonderful since the 80s when inflation sky high. Now, going into some of my final thoughts. One of the things I found really interesting that I think is kind of demonstrated through walking through the process and then also giving some of the examples was that this formula doesn't necessarily seek to maximize wealth. And, well, what do I mean by that? Well, for instance, if we go back to my example I gave earlier of the two couples who both same age, but one has more in investable assets, one has less, right? And it gave a more conservative recommendation to the couple with more investable assets. This isn't necessarily a wealth accumulation mindset. And Choi purposefully did this, and he actually described that his formula isn't meant to accumulate the most wealth that you can possibly accumulate, right? It is to maximize the utility of the wealth, focusing more on terms of what you'd actually spend the wealth on and things of that nature. Now, describing the utility of wealth. This is an interesting thing, but I kind of like this mindset. Basically, giving a quick example to kind of describe this in real time. If you have an individual and they have $0 to their name, right? They're probably homeless. They can't afford clothes. They can't afford food, right? Horrible situation. None of us ever want to be in that. The difference from someone who has $0 to now someone who has $100,000 in their bank account, it's well dramatic. They now have clothes, they now have food, they now have structure, they can live, they might have a vehicle, they can move around, right? That is a big, big, big jump. Now, that jump in and of itself is actually more important than, say, if you had a retired individual who had $5 million versus that same retired individual with $6 million, right? They might update and renovate their house, they might go out to eat a few more times a year, right? But those aren't like major lifestyle changes. For the most part, if they're very comfortable living on $5 million, even though it was a $1 million jump versus our first person who jumped $100,000, right? It's not going to dramatically change their life. And then taking this example to the obvious extreme, right? If Elon Musk has $440 billion or whatever, right? How much utility is he going to gain by getting one extra $1 billion, 447? He already has all the money he'd ever need, right? He's can spend it on whatever he likes. He can buy whole companies. That extra $1 billion is like pennies to him. And I think that's kind of the focus of the Choi formula, is demonstrating an emphasis on actually gaining utility on the income you've made. Now, obviously, this formula isn't perfect, right? It doesn't incorporate every single thing that you would want to be incorporated into a formula to give you an exact amount of equities to fixed income you should have in your portfolio, right? It doesn't take into account if you have a mortgage you're still paying off, or if you have student loans, or if you're going to get a large inheritance from a relative, right? These are things that you wouldn't possibly expect a one size fits all formula to incorporate. And therefore, I don't necessarily think that it should be taken at 100% face value. This is what you need to do. However, that doesn't mean that we can't derive good understanding from this formula and kind of be given some good takeaways. And that being that primarily we should put more emphasis on investing in equities because they outperform in the long run. And if we can ourselves manage it, obviously, if you are someone who would have plopped in a 10 risk tolerance, you're probably not going to be jumping into a 100% equities portfolio. But maybe try and jump a little bit out of your comfort zone, because you might have a financial situation that not only allows that risk, that added risk, but you might actually benefit from it dramatically versus taking on no risk. And I think that's a really good takeaway to have in this formula. Additionally, another fun takeaway, right? Most formulas are awful. I think that is a pretty fun takeaway to have from this, right? Most of them you're going to have just wild differences, and they can't even account for the basic inputs of future earnings, future social security. Like, they don't take that into account. They don't take into account your risk tolerance. These are basic things that should be inputted when picking your investments. Like, for instance, if I was someone who is locked in a target date fund, right? And I really hate target date funds. I would probably pick target date funds that are way past my retirement date because I understand the power of having equities and building a portfolio around equities, right? And the difference it's going to make to have a compound annual growth rate of 8 to 10% versus a compound annual growth rate of 5 to 6, right? In 1 year, that difference isn't necessarily a lot. But in 40 years of compounding, that difference is insanely large. And so I think these are some of the takeaways that a formula like this and implement into personal finance will actually show. Overall, thank you so much for checking out my video. I really appreciate your time. I hope you gained a little bit of insight into this. If you yourself want to check out this formula, it's really easy to find. You can kind of just look up Choi formula and it will pop up on most Google results. And you can find not only the articles about it, you can also find the actual research paper if you're interested, or gain access completely for free to the actual spreadsheet if you'd like to go that route. So overall, thank you so much for checking out my video, and I really appreciate your time. Thank you.